Welcome back to the channel. Today we're diving deep into one of the most talked about and debated names in the entire public markets right now, Rocket Lab. If you have been watching the market lately, you have probably noticed Rocket Lab becoming the unexpected star of the space economy conversation. And if you are trying to decide whether this massive run-up still has fuel left, or if the stock has already crossed into overhyped territory, then this breakdown is exactly for you. Rocket Lab's share price has been on an almost surreal rise, climbing 28.6% in just a week, another 10.8% across the last month, and an astonishing 130.4% so far this year. When you stretch the timeline out even further, the numbers become even more dramatic: a 1,296% surge over 3 years, and over 450% across the last 5 years. These are the kind of returns that turn quiet industrial companies into headline-grabbing momentum stories. A lot of this rise comes from a combination of factors converging at the right time. Investors framing Rocket Lab as one of the few pure-play opportunities in small launch technology, a renewed focus on satellite manufacturing and end-to-end mission support, and a broader wave of speculative and thematic capital flowing into anything connected to space, defense, national security, and next-generation infrastructure. Once you combine that with every positive announcement, every successful launch, and every contract win being amplified by market sentiment, you get a stock that behaves almost like a narrative-driven rocket itself, pushing higher with each new burst of optimism. But when a stock moves this fast, the next question becomes whether the fundamentals justify the excitement. And that is where valuation models enter the picture. Analysts often rely on a discounted cash flow approach to assess what a company is truly worth by estimating how much money it will generate in the future and then bringing those amounts back into today's dollars. For Rocket Lab, the model most commonly used is the two-stage free cash flow to equity method. It starts from an uncomfortable reality. Rocket Lab is still burning cash, posting around negative $220 million in free cash flow over the last 12 months. From there, the model tries to estimate how that number shifts as Rocket Lab scales up its global launch cadence, ramps production inside its space systems division, and works toward major milestones like bringing its Neutron rocket online. Analysts forecasting the company's trajectory expect free cash flow to steadily improve, eventually flipping positive and pushing toward roughly $612 million by 2029 and potentially reaching almost $1.34 billion by 2035. Simply Wall Street pulls these analyst expectations together and extends them into a full long-term projection, discounting each future year back into today's value to estimate what Rocket Lab's equity might be worth right now. The result of that exercise lands at around 37.82 cents per share, which is striking because it suggests Rocket Lab's current price is roughly 52% above this intrinsic value estimate. In simple terms, that means the market is already assuming a very optimistic version of Rocket Lab's future, one with high growth, high margins, and strong operational execution. This video is for informational purposes only and is not financial advice. Always do your own research and consult a professional before making any investment decisions. For companies still losing money, investors sometimes avoid relying solely on cash flow projections and instead turn to asset-based valuation metrics like the price-to-book ratio. This measure compares a company's market value to the net assets it owns, and it can sometimes give a clearer picture of how the market is pricing growth and risk. In theory, companies growing quickly or facing lower risk deserve a higher price-to-book ratio, whereas companies growing slowly or facing higher uncertainty typically trade closer to the industry average. Rocket Lab, however, is trading at around 23.99 times its book value. That is not just above the aerospace and defense industry average of roughly 3.5 times. It is far beyond the peer group average of around 9 times. This doesn't automatically mean the stock is doomed or outrageously priced, but it does show that investors are paying a substantial premium based on expectations for what Rocket Lab could become in the future rather than what it is today. Because broad peer averages can be misleading, especially in industries where different companies pursue different segments of the market, Simply Wall Street uses a refined, fair ratio framework that accounts for Rocket Lab's specific risk profile, profitability outlook, long-term growth expectations, and competitive environment. This approach doesn't try to compare Rocket Lab to companies whose business models don't match. Instead, it builds a valuation tailored to the company's actual operations. Even through this more precise lens, the market's current enthusiasm looks ambitious, suggesting the stock price may already be factoring in a lot of future success. But valuation is not just about numbers. It is also heavily shaped by narrative, which is why tools like Simply Wall Street's Narratives feature give investors a way to build their own story of Rocket Lab's future. This tool lets investors input their assumptions about revenue growth, margins, expenses, and risk factors, and it then translates those assumptions into a fair value estimate. What is fascinating is how different narratives produce dramatically different valuations. A cautious investor might build a moderate scenario where Rocket Lab grows steadily but faces realistic challenges in execution, resulting in a fair value around $31.72. Another investor, one deeply optimistic about the company's technological edge, defense sector positioning, and ability to scale, might produce a fair value closer to $65.67. Assuming margin expansion, strong contract wins, and consistent year-over-year revenue growth. These competing narratives show how two people can look at the same company, the same data, and the same industry trends, yet arrive at completely different conclusions depending on what they believe the space economy will look like 10 years from now. In the bullish version of Rocket Lab's future, the company grows into one of the most important vertically integrated players in the entire orbital economy. Under this viewpoint, the company's entire ecosystem, launch services, spacecraft manufacturing, satellite component production, mission integration, and eventually medium-lift launches through the Neutron rocket begins reinforcing one another. Government agencies, defense departments, intelligence networks, and national security clients increasingly rely on Rocket Lab not just for launches, but for end-to-end space infrastructure solutions. Revenue growth remains strong, climbing at a pace above 36% annually, and margins steadily improve as research and development becomes a smaller percentage of revenue and scaled manufacturing takes over. The risks do not disappear. Rocket Lab still faces cash burn, competitive pressure from SpaceX, and the heavy lift of getting Neutron operational. But in the bullish worldview, these challenges are stepping stones rather than roadblocks, and once Rocket Lab reaches operational scale, the cash flow dynamics justify a premium valuation equal to or even above the $65 estimate. The bearish narrative paints a very different picture. In this version, Rocket Lab is indeed part of a massive space infrastructure ecosystem, but achieving its long-term vision requires flawless execution, something rare in aerospace. To hit revenue targets such as $6 billion by 2035, Rocket Lab must simultaneously perfect Neutron, maintain Electron's launch reliability, expand its space systems division, secure major government contracts, and control its cash burn, all while competing with SpaceX, a company that redefines launch economics every year. In the bearish scenario, the Neutron rocket becomes the central point of vulnerability. Its success could elevate Rocket Lab into a new category of competitors, but its failure could undermine the entire growth thesis, placing pressure on finances and investor confidence. The bear case also emphasizes the intensely competitive geopolitical environment surrounding space technology, where delays in government approvals, shifting budgets, or international developments can reshape entire revenue pipelines. Under this narrative, the current stock price looks overly optimistic, making the more conservative fair value of around $31 feel far more reasonable. In the end, Rocket Lab has become one of those rare companies where valuation depends as much on belief as it does on financial modeling. The stock's extraordinary rise tells us the market is betting heavily on the future of the space economy and Rocket Lab's role in it, but the models and risk factors remind us that the road ahead will not be simple. Whether you see Rocket Lab as an emerging powerhouse with multi-billion-dollar cash flow potential or as a promising but overextended player facing immense execution pressure ultimately comes down to which narrative feels more convincing. And that is the real story behind Rocket Lab today. A company suspended between remarkable possibility and equally remarkable risk, where the final outcome